Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's January 5th, 2023, our second show of the new year. We got a big show coming up. We had the Fed minutes come out yesterday. We're going to dive into that because that is important for your money, your portfolio, and where the market's going to go in the next couple of months. We're also going to talk about the housing market. The housing market is something that people have not quite figured out what's going to happen in 2023. We dive into some numbers, give you some insight into that, and then we'll wrap the show with your questions. The Q&A we took from Twitter, diving into individual stocks, getting my honest, down, and dirty opinion. All that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It's the 5th of January, 2023. It's a beautiful Thursday down here in South Florida. Sun is shining. The warm air is beating down. I could smell the salt water from the ocean. It's a good day. That being said, the market did open lower today, and we are down a little bit on the year. But again, this is the third trading day of the year here so far, and we got obviously a lot of days left. About 361 days, give or take, if I'm doing my math correctly, for 2023. And I still believe 2023, there will be a massive rally at some point in stocks. We could still have lower to go in the near term. I've said that on the opening show on Tuesday. That being said, I do think we're going to get to a point where the big catalysts that have been holding the market back, being the Fed, being inflation, you can throw valuations into that as well. Geopolitical issues will start to subside a bit. And as that happens, we will see investors who are massively forming an army on the sidelines, if you will, and cash move back into equities at some point in 2023. But let's talk about what's going on here, just kind of kicking off the year. We've seen a lot of the leaders of 2022 actually fading a little bit in the first couple of days, and some of the laggards picking up a bit. The reason for that is a lot of times people will sell laggards at the end of the year for a tax loss and then get back in. Remember that if you do sell a loser in a taxable account, you want to take that tax loss, you need to at least hold off at least 30 days, what's called the wash rule. So otherwise, the IRS won't let you take that loss. But again, always consult your accountant on that. But people have sold throughout November, December, buying back in for 2023. So we're seeing that's typical when the market kicks off a new year and a calendar flips over. Some of the leaders of last year, you see some profit taking because they don't want to pay taxes on any profits in 2022. So let's push it out as far as we can into 2023. United Health's an example of a big company that had one hell of a year, but since we opened trading here in 2023, it closed the year around $530 a share. We're down to $493 this morning, down to 2.2%. So you are seeing some profit taking. Some of the healthcare stocks, United Health, UNH, just happens to be one example of that. As I mentioned, even though these first couple of days have been kind of wonky, I think this really first 3 months, quarter is going to be like this. After that, I believe at some point we're going to have what they call rip your face off rally, a big, big rally in stocks. I'm not saying you jump in and do it now, but start preparing your watch list for the stocks you want to own, the beat down stocks that look good, in preparation for when that happens. And we'll see signs that that's coming before it actually happens. Yesterday, we had a big rally in stocks. Kind of started in the morning and really kept going throughout the day, gaining momentum until the Fed minutes came out from the December meeting. When the minutes came out, we initially gave back those gains and went into negative territory in some of the indices. But then we had some buyers come back in and ended up closing higher for the day yesterday. Big reason for that was the Fed basically was saying that we're going to continue to keep the pedal to the metal, and we're going to knock out inflation. We're going to slow down the hot jobs market, and we will continue to be aggressive in interest rates. I think the Fed has completely lost their mind. I mean, most people think the Fed had lost their mind many, many years ago. And I held out and I gave them the benefit of the doubt, as I tend to do in situations too long. Ask my therapist. So I gave them the benefit of the doubt. At this point, I've given up on them. I mean, you have to just kind of wash your hands of them, walk away, and be like, listen, you guys effed up, and you continue to F up. Because we are seeing inflation come down. We're seeing underlying metrics of inflation that will trickle in over the next couple of months come down. Does the housing market remain hot? Yes. Not housing. The jobs market remain hot? Yes. I'll talk about that in a moment. But the thing is, the Fed is just, they're overreactive. Instead of being proactive, they're reactive, and they're reacting to inflation going so high last year that now they're scared that they can't get under control. My fear is that they go so strong that they put us into a deeper recession, a shallow recession. I mean, people are saying we're going to have a recession in 2023. I think we've been in a recession. I don't care what the numbers say. I think we've been in a shallow recession for the last 6 months. And I think that will continue for a few months this year. That being said, stocks typically bottom before people even tell you it's a recession. And that's why I think that's good news, because the economists, who are worthless, in my opinion, will come out later this year and say we're in a recession. By that time, it's too late to sell stocks. They've already bounced back from that. So as far as the jobs market is concerned, we had the ADP number this morning. This is kind of the precursor to the numbers that come out Friday, the jobs numbers from the government. ADP Independent, they came out and said private employment rose by 235 jobs in December. It rose by 127,000 in November, so a big, really step up. And keep in mind, economists are looking for a gain of 150,000 jobs. So again, well above expectations. Wages continue to be hot. They were up year over year, 7.3%, a little bit higher than what, again, these economists were expecting. That's all they do is predict numbers, and they're not very good at it. The JOLTS report came out earlier this week. That was a little bit stronger than expected, and that will kind of weigh against stocks a little bit. So what we're seeing is right now good news. When I say good news, I mean that I keep saying housing. The jobs market is strong. Wages are going up. The JOLTS number, which is, again, more jobs data, strong. We think that'd be good because that means people are getting jobs and making more money. However, that is hurting the market because the good news in the jobs market actually scares people that the Fed's going to be more aggressive, which means interest rates go up, which means the market goes down. So that's why we're seeing that. We saw the ISM manufacturing number come out this week, though, and that was weak. The first time we saw a contraction, that means a reading below 50 in 30 months. That was actually good for stocks. So we're seeing a bit of the opposite of what should be happening. And tomorrow morning is going to be really kind of the big number. We have the number for December coming out, the jobs number from the government. Expecting a gain of around 200,000 jobs, down from November, which was high at about 263,000. So we'll see how that ends up playing out. But I will tell you that right now the jobs market does remain hot, and that's not necessarily a bad thing because, as I've been saying, when inflation comes down, your wages will likely continue to remain where they are. And as they remain high, now your real wage growth is going to be positive. The real wage growth, you take your year over year, say it's 5%, I'm using numbers, and say inflation's up 7%, your real wage growth is 5 minus 7, so negative 2%. But if inflation falls down to 3%, your real wage growth is actually 2%. 5 minus 3 is 2%. It's your real wage growth. You take out inflation because your wages could go up, but if the cost of living goes up even more, your real wage growth is a negative. I want to show you a chart here, and this is I got this from McKinsey, and this shows that majority of people who quit their jobs in the last 2 years are not going back to the same industries they left, which I find pretty amazing. 17% didn't go back to the workforce at all. I'm not quite sure what the hell they're doing, unless they're just so independently wealthy they don't have to work. I don't know. I have to assume they will go back at some point, and when they do go back, means there's more people fighting for jobs, which means wage growth will not be as high for certain situations. 48% moved to a different industry. That I thought was really, that's half the people to a completely different industry. So that means about 65% of people did not return to the same industry because they either left the workforce or went to another industry. 2 out of 3 people. That is a high number. That really caught me off guard when I saw that report this week. But again, it shows the fact that employees still have the upper hand over employers. And I like that. Don't get me wrong. But at some point, it has to come back to maybe neutral and even go the other way. So when that does happen, the Fed will immediately stop raising rates. And I still think they will stop after the March meeting. I think that will be the end. But we'll keep an eye on that as it goes forward. But that's why the market's been so volatile this week, because people are trying to decipher the economic numbers, what the Fed's going to do, decipher the Fed meetings, which they're pretty adamant that they're going to be aggressive. Or maybe they're just doing that to scare the market down. I don't know. I've not figured out this Fed. I don't know if anybody can. I mean, if there's a Fed whisperer out there, please contact me because I have no idea what the hell they're doing. And the last thing I'll say in the Fed is they base things off projections and numbers and data. I love data. I'm a numbers nerd. It's one of the things I love the most. I love statistics. That being said, in a classroom in academia, numbers mean one thing. In the real world, it doesn't quite work that way. And a lot of the people that work with the Fed have done nothing but really been in academia and in the government and not really had the real world experience. And that scares the hell out of me because sometimes they think they're smarter than they are and you get in trouble like we're in trouble right now. I don't see we're in trouble. The trouble we've been in with inflation is due to that, in my opinion. All right, let's shift over to housing. I want to talk about the housing market because, over the holiday break, I was in 6 different states all over the place in another country. And people always ask me about the economy because they know what I do. They ask me about the stock market. But housing was a really big topic that people kept bringing up. And did a little bit of research over the last week or two. I just want to show you a couple of stats here to give you an idea what's going on with the housing market. And keep in mind, the housing market is very regional because the housing markets may still be very strong. I have a couple of good friends that I was with on New Year's Eve here in South Florida that are in the housing industry. And things, for the most part, remain pretty damn strong down here because people want to keep moving here. So there are areas that remain very strong as other areas have fallen. However, I want to show you the U.S. House price index here. And as you can see here, this is year over year change. The latest number is still nearly 10% price change year over year. So it's still a high. But if you look back, through 2018, 2019, you average around 5% or so. Then we spiked up to nearly 20. We're working our way down. What I want you to really focus on the right side of this chart is that after the spike, that spike came obviously during COVID lockdown. Everybody started buying houses, moving out of the city. So you had this huge spike up. Then we went sideways for a while and now we're rolling over. We're going to get back to normal, I believe. And the thing, what we're seeing here is we're still above where we normally are, but that pullback that we're seeing in the price of homes is actually a good sign as far as inflation is concerned, as far as people, new home buyers out there looking. So that is a chart that I think is really important. Another one to look at, we'll take a look at here is U.S. existing home sales. And as you can see here, again, we go back, and this goes back way back to the late 90s, but you can see on the right-hand side, the big spike from 2000. That was during the pandemic. We've come right back down to that level, and now down to a level that's very low, down to just over 4 million homes here. So we've come down quite a bit in a lot of the housing numbers, and I believe we're getting to a level now that we'll probably see lower prices in homes. I think that 9, nearly 10% number will come down to 5. So I think we're going to see how prices continue to go down. There's 2 things I look at that is really a saving grace when it comes to home prices. And again, this is just nationally. Regionally, it's going to change. Here's the first chart. And this is the U.S. existing home inventory. You see it spikes, like once a year it spikes and then comes down because obviously it's seasonal. But the trend here, really since we spiked or topped out around 2007 when the housing bubble kind of burst, we had so many homes, obviously if it's that many homes on the market, prices come down. They've come down so low. The inventory's dropped from about 4 million down to about 1.14. And this tells me simple supply and demand, folks. There's still a lot of buyers out there, first-time home buyers that want to get into a home. but inventory remains low. So demand remains high, inventory comes down. That gives us a bottom in prices. So this is one chart that has me bullish long term on the housing market. Again, I think in the near term, housing prices still need to come down a little bit. The longer term, that keeps me bullish. The other thing is that today only about 5% of mortgages are on adjustable rates, ARMs, adjustable rate mortgage, ARM. So that means that whether it's a 3-year ARM, 5-year ARM, 7-year ARM, that if you purchase a house and you do an ARM and you lock in an interest rate, but say it's a 5-in-1 ARM, means in 5 years you have to refinance that mortgage. So say if you locked in at 3%, but interest rates in 5 years are now 5%, that's the best you can get. You're locking in at 5%. So your payments will go up. We're only about 5% of mortgages are sitting in ARMs, which is really good. Take that back to 2007, I just talked about when we saw those spikes. Inventory is super high. Look back then, over 20% were sitting in ARMs. So when they re-up and they had to refinance, it wasn't as much about interest rates spiking. It was more about the value of the homes dropped so much that they were actually underwater. And it led to a ton of foreclosures. And we know the story about 2007, about 2009-ish with the housing bubble. And even if you go overseas, you look at the UK, United Kingdom, only about 14% of mortgages right now are ARMs. Back in 2005, when their housing bubble began, it was about 70%. So we're in a much better liquidity situation right now than we were back in 07, 08. So the comparison isn't really the same, folks. I understand why people do it, but it really is not the same. Another chart I want to show you here is mortgage rates. And you can see this is one reason that housing has become less affordable. You can see, mortgage rates, 6.42%, give or take. It really varies, on, again, your credit score, where you're at, home price, etc. But this is where about the average right now. Well off where we were. But again, look at going back to the 80s. This is really not super high. A lot of young people, I wasn't buying a home in the 80s. I was single digits back then. So I wasn't buying homes. So I don't know. I bought my first home, I guess it was around 2000, 2001. So they're much higher then. And this will keep the housing market a cap on it. That being said, if interest rates roll over, which I think they're going to at least stop going up, and then probably roll over by the end of next year, 2024, mortgage rates could come down too. Again, longer term bullish, short term bearish, longer term bullish for the housing market. Last thing I want to show you here is how have the housing ETFs and stocks done? Take a look. This is over the last year, the last 12 months. The S&P is down around 18.3%. And the two large housing-related ETFs, you can see here, this is the iShares U.S. Home Construction ETF, symbol ITB, down about 22.5%. And then the S&P, the S&P Home Builders ETF XHB, down about 25.5%. So they have been lagging the market, but as you can see, it really lagged it early last year, March, April, May, June. Since that time, they've taken that gap and they've really narrowed it, saying that the housing stocks have actually performed better than the market over the last few months. So we are starting to see a bit of a turnaround. And again, I'm not running out buying housing stocks right now, but I think it's something to put on your radar for maybe later next year, because I think there will be a nice opportunity because demand remains high, inventory remains low. So that's good for home builders down the road. And then I asked on Twitter this morning, last minute, we want to take a look here. I asked people on Twitter, I said, ask me some stock questions. I'll dive into them for you. And I'm going to do that right now. And I'm looking at these for the first time, just so you know. I'm jumping into it the same time that you're seeing me jump into it here. And just one thing I just mentioned, I just want to follow up on this. If I look over the last 6 months, in housing, it just happened on this chart up, that the housing stocks I just mentioned. In the last 6 months, folks, the S&P 500 is up 1.5%. The two housing ETFs are up 11.3 and 15%. So they're coming back the last 6 months. So maybe it's time to get in. I'm going to be cautious and hold off. But just to give you an idea, they are starting to turn around for the reasons I mentioned, long-term investors looking for opportunity. So let's take a look at a couple stocks here that people asked about. The first one we'll take a look at is symbol DOX. VOCS. And this is a company by the name of Doximity. And we'll take a look at the chart here real quick. See, it's been in a downtrend, but it's in health information services. We'll come back to the chart here in a minute. But this is a company that I've had my eye on for a while. I know this company pretty well. So it's not a large company, but it has good market share in what it does. So Doximity is about a $6.2 billion company, and they have a digital platform that the medical professionals use. And a large percentage of medical professionals use that. It's all cloud-based. And they have tools that are help colleagues really kind of almost like there's like social media aspect of it, but also for patient care, they can do the virtual visits with that. They also can do sales through it. So pharmaceutical companies use it for new sales. It's really just this huge community, but also there's a connection to patients as well. And that is where the medical system, healthcare system is going because they've really been lagging behind, in my opinion, for many, many years. 2021, it had revenue of 206 million. This year, this fiscal year that just came out recently, 343 million. Looking to about 650 million by fiscal year of 2025. So you're seeing nice growth on the top line. What I really like about this company, it differentiates itself from a lot of other kind of smaller mid-cap companies, small mid-cap companies, is last fiscal year, they generated 82 cents a share. And that looks like it's going to continue a little dip this year, but then picking up again. So this is a company that's actually making good money. It has a big percentage of market share. But again, look at the chart. The chart you can see has been in a downtrend with basically anything that's in this sector. But what you do see is after bottoming in November, it's gone sideways and it's building a base. So I like the action here. Again, this is something that you want to keep an eye on this stock. And keep in mind, folks, nothing here is a buy or sell recommendation. Nothing at all. So these are just my honest opinions looking at stocks really on a whim here because, again, I'm just pulling these off Twitter right now as we're doing the show here live this morning. The next one is also going to be in the healthcare sector. Maybe there's a theme we're seeing here. And this is a stock called InMode, symbol INMD. And they do non-invasive surgical aesthetic and medical treatment solutions. So they use energy-based treatments for your face, body contouring, for fat removal, women's health. Also there, they have, consider them a plastic surgery company, a dermatology company. They're also involved in gynecology. So this is, if you maybe have heard of some of their brands, Body Tight, Optimus, Contura, Evoke, Evolve, Morpheus 8. It's about a $3 billion company. And again, nice revenue growth. Last year, 357 million. This year, looking for 450, up to 600 by 2024. And we flip over to profitability again. Last year, they made $2 a share. By 2024, looking for $3 a share. That means this stock trades with a forward PE ratio of 12. Again, this is a company that's making money. Forward price of sales of 5. It's got a PEG ratio, which takes a PE over its growth of less than 1. That's a very impressive number. And so let's take a look at the chart because obviously what's the chart going to tell us with InMode? Again, the symbol is INMD. And take a look here and what we can see is very similar to Docs, except for this one bottom in May and July, but it's been building a base since then. And really, if this breaks above 40, this thing could take off. And again, because of the valuation is pretty good, I like the way this is set up. And this is a niche company. This is the type of company that you may have heard, you may not have heard of. You don't think of it when you think about huge innovation and growth, but baby boomers getting older, Gen X, my generation getting older. People want to look good. It's very important to them. You look at the list of New Year's resolutions. It's always about looking better, feeling better, health, eating better. Sometimes it's an easier way to go do that through aesthetics, and non-invasive is the way that it's kind of the trend of the future right now. So you are seeing companies like this do really well. So we're going to shift gears completely, and we're going to go to a major oil company. And if you haven't guessed it yet, here we go. ExxonMobil, symbol XOM. We had a few people ask about this. Stock just pulling back from an all-time high, consolidating. Even though oil prices have come down a bit, this stock has held up very well. For me, ExxonMobil, not my favorite in the oil and gas area. I do believe that energy stocks, oil and gas stocks will continue to do well in the next couple of years. And, not straight up, but I do like them. There's a couple other stocks out there I like a little better, but I do think it is something where I talked about this in a newsletter I put out recently, the barbell approach, where clean energy is the future, long term, absolutely. But on the other side is barbell, as you know, there's two sides to it, is dirty energy that is going to continue to have huge demand going forward. And that's not ending anytime soon. I'm just about to finish up a good book. My first book of the year. I'm almost done with it. It's called Numbers Don't Lie by Vaclav Smil, Smil. It's a very good book. It's very easy to read. It's little sections. There's like 75 different little 5-page things in it. And a large portion of this has to do with energy and just talking about the amount of energy that is needed to build out clean energy in the future. You have to keep in mind that electric vehicles only make up still about 3% of global vehicle fleet. To get to where we need, eventually it's going to be 100%. It's going to take decades. But along the way, that's going to take a lot of building out. Solar is only about, 3 or 4% of the energy here in the United States. Wind is really picking up, a lot more offshore going on. But to build all this stuff, it takes fossil fuels. It takes dirty energy. When you plug your EV in to your garage now, the likelihood of that coming from clean energy is very low. There's a few countries out there that can do it. France, because they get a lot from nukes. Some of the Scandinavian countries get a lot from hydropower. But here in the United States, it's not it. Like, you're still pulling power from dirty fossil fuels. So you still need energy out there. So I think ExxonMobil can be I think it's going to do well. I think it's going to do very well in the next couple of years. I just think there's some smaller larger caps and mid-cap stocks that I prefer in the area. But that being said, I think it is a area that cannot be overlooked. And keep in mind all these numbers I'm talking about, how, the jobs market is still strong. The housing market, I think, will have a bottom here very, very soon and won't be a big, deep pullback like we saw in 07, 08. That's good for the economy. And as the economy is strong, that means there's, again, more demand for fossil fuels. Remember, China's just kind of reopening. And I don't care what you think about China. It's still the second largest economy in the world. It's still one of the fastest growing economies in the world. It's still one of the most populous countries in the world. I mean, there's a demand. And yes, they're moving towards clean energy as well, but they don't give a shit like us. Maybe we don't either. Maybe it's just good for headline. But you're going to still see they rely heavily on dirty energy. Coal, gas, oil. It's not ending anytime soon. All right, so next one somebody asked about was Celsius Holdings. We've talked about this in the past with the guests we had on, and this is a company I like. Take a look at the chart here. This is a stock that rallied to a high. It's pulled back recently about a 15% pullback, sitting on a 50-day moving average. Chart still looks good. And if we take a look at a longer-term chart, obviously it would have been nice to buy back in single digits. It's at 102 now. But I like this company. This is a company that, it gets big investments from Pepsi, but I think at some point you're going to see them really just buy the whole company. I think at some point you're going to have to see them bought out. I mean, it would make much more sense to see them just come in and buy the whole damn thing versus just picking little pieces here and there up. They took a $550 million stake back in August. This is, to me, this is a long-term partnership they've been working on for a while. And I've never had a Celsius. It's, the healthy energy drink. I have one in my refrigerator that somebody left here, but I've never had it myself. And it's still only a $7.8 billion company. So it's not like you're looking at a huge company. But you look at sales, folks. 2019, 75 million in sales. 2020, 130. Last year, 314. This year, looking for 651. Next year, nearly $1 billion in sales. That's true top line growth. It was profitable last year to the tune of 5 cents a share. This year, looking for 57 cents. Next year, looking for $1.20. Huge growth. So yeah, I like it. I like Celsius. Again, nothing here is a buy or sell, but I do like Celsius, and I think it will be bought. I don't think it's going to be bought out for a year or two because they just invested a lot of money in August. I don't see it being bought anytime soon, but I do think it eventually gets bought out. I think it's inevitable. One more I'll take a look at, and this is in the consumer space as well. It's funny because Celsius I've never had. I don't do energy drinks. I don't do caffeine. I gave up coffee 6 months ago, so it's not my thing. Never had a Monster Energy, none of that stuff. Uh, CROX, CROX is a symbol. Those are I'm going to piss somebody off, but those ugly ass rubber looking logs, if you will. I know they're big with the young people. I know they're big in certain industries. Um, Company based out of Colorado, Boulder. I remember when it first started up, I was living out there, and a lot of people made a lot of money. That's first employees. Stock though, like I don't get it because I think they're the ugliest things in the world. But let's take a look at the chart here. Crocs uh, yesterday traded at the best level since February. So you're looking at what about 11-month high? It's down a little bit today, but after bottoming in July, this stock has gone from below 50 to 107, more than doubled. Well, that's a good looking chart. And again, if you zoom out, take a little bit of a longer term look at Crocs, had a hell of a run, down from single digits up to about 182, all the way back down, working its way back up. And then what you have to think about now is, okay, where we stand fundamentally, about $6.6 billion company, and it's low valuation. Last year, 2.3 billion in sales. This year, looking for 3.5, over 4 by 2024. And then, of course, is it making money? All these stocks have something in common. They're making money. Last year, 8.32 a share. This year, looking for 10.32. 2024, looking for $12 a share. Core P ratio of 8.8. Forward price of sales of 1.5. Those are cheap numbers, folks. Those are truly cheap. And again, the stock's more than doubled in the last 6 months. So I don't know if you buy it here. It could pull back to 95 and look really good. But this is a company that you just can't ignore. But it's flying under the radar. Not a lot of people are talking about it. Meanwhile, it's more than doubled in the last 6 months. So even though the market's been tough, there are opportunities out there right now. Don't forget that. There's always an opportunity out there. Any old timer on Wall Street will tell you that. I think as a market overall, we're going to see a lot of opportunity in the next couple of months. And we'll be here ready for you with some good watch lists to kind of guide you when that happens. But we'll wrap the show here with the S&P. We'll take a look at it down about 1% on the day. And we have the QQQs, which is the NASDAQ 100, down about 1.2%. So both trading lower right now. Again, I think the first couple months of this year are going to be absolutely bananas. Big up days, big down days. I think you want to be in the market with what you have and the cash on the sidelines. Get ready to start doing some buying in the next couple of months as these opportunities arise in individual stocks and the overall market. But again, if you have any questions, please put them down below in the comments. Don't forget to like, subscribe to the channel, share it, let your friends and family know. But again, if you missed the first show, Happy New Year. Welcome to a beautiful 2023. Looking forward to a really healthy, prosperous, and fun year this year. And I think we're going to see one hell of a stock market rally at some point this year. So buckle up and get ready for it. Again, thanks for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.